What is up, everybody? This is S Trades, and this is day 6 of the bootcamp. And in this video, we're going to be going over fair value gaps, also known as inefficiencies, which I kept mentioning and hinting in the previous video. So yeah, let's get straight into the video. So as I kept mentioning in the previous video about liquidity, market moves in two ways. Market either seeks liquidity, either takes out liquidity, like a liquidity run, like again mentioned in our previous video, or it rebalances inefficiencies, one or the other way. Okay, so in case of rebalancing inefficiencies, as I said, not to worry about, what it pretty much is it's imbalance in price, imbalance between buyers and sellers, right? Where one side was more aggressive than the other. So as I said, a fair value gap simply is just an inefficiency in price where a market is in a very heavy momentum, has a lot of displacements towards one side, and it leaves off inefficiencies or imbalances in prices at one side of the market. For example, if you're looking at a bullish fair value gap, it means at this current moment the buyers were a lot more aggressive than the sellers, which made price pretty much have this big momentum candles with a lot of displacements, leaving this fair value gap, right? And in a bearish fair value gap scenario, it's just the opposite, where the sellers were more in control of the market, they were more aggressive, so they left off this inefficiency, leaving off a fair value gap. Now, a fair value gap, again, is just a name. There's different names for different styles of trading. For example, if you're using ICT concepts like me, we call these fair value gaps, but they're also called inefficiencies. If you're using order flow, they're also called like low volume nodes. So they all pretty much mean the same thing. So if you ever hear a low volume node, inefficiency, fair value gap, it's pretty much all the same thing. It's just inefficiency in price where one side of the market was a lot more aggressive than the other. And what it pretty much is, it acts as a magnet. So when a market pushes up, it doesn't forever just keep on going up. At some point, it retraces back to what? To the inefficiencies, ends up filling those inefficiency of orders, and then once it does that, it makes the move continuously either bullish or bearish. Now, how does a fair value gap look like, right? So it's pretty much a 3-candle formation. So as you can see, these wicks of the candles, see, as like we have 1, 2, 3, we have 3 candlestick pattern formation, right? And in the middle, there's this big gap. There's this very big displacement candle that left off this whole entire area unfilled. This is where price has unfilled orders, where price was very heavy momentum, where it left off a lot of people aside. Like, people weren't able to do much in this area because price was just super fast, right? It left all of this low volume, right? If you're using order flow, you would call this a low volume node. So yeah, you can see the candles do not meet at all. They don't intersect, so leaving this big fair value gap, right? And in bearish fair value gap scenario, it's the same thing, right? We have this have this 3 candlestick pattern formation, right? 1, 2, 3, and in the middle we have this big momentum candle, leaving off this big fair value gap, again leaving off this inefficiency for price to eventually retrace back to this area and then continue to move lower. Now, if you're using ICT, this is also is used as a SIBI, which is sell side imbalance, and then this is known as BC, which is buy side imbalance. So again, these are just all different names. You know, they all pretty much mean the same thing. What ICT concepts always try to do, they always try to sound extra smart with extra terminology that you just, you know, try to sound super smart or make things complicated, but just call them a fair value gap, let's say, or inefficiency, whatever you guys are comfortable with. That's pretty much what it is. So again, just a quick recap of what we just said. A bullish fair value gap is when there's lots of aggressive buyers, right? There's a lot of momentum in a move, leaving off this gap, which is also known as a fair value gap. The wicks of the first candle and the third candle do not meet at all in between, in the middle right here, right? And which pretty much leaves off this big inefficiency. And what it does, it just acts as a magnet to eventually price ends up retracing back to this area, filling those orders that were unfilled, and ends up going higher. And in a bearish fair value gap scenario, again, same thing, but just reversed. There was a lot of sellers at the moment. There was a lot of aggressive sellers, right? It's not that there was more sellers than the buyers, because that's impossible. There's always an equal seller for every buyer, right? So in this scenario, there were just more aggressive sellers at the moment. They left off this fair value gap, this inefficiency, for them to price act as a magnet to pretty much retrace back up to the zone again. Because why? The wicks haven't touched at all the zone, so this is counted as a fair value gap. And then once the orders get filled, price ends up continuing down. Now, if you guys are following the bootcamp, I keep on saying how trends move, right? They don't just constantly just forever go up and forever go down, right? So all of these retracements, right? All of these retracements, right, is usually to some sort of a fair value gap, right? They always retrace back to some sort of an inefficiency, right? So as I said in the previous video, right here we have liquidity, right? And this and these highs, right? Price ends up taking out the liquidity, right? And then leaving off the inefficiencies to then what? To come lower, fill those unfilled orders, and then keep on going higher, right? So like I said earlier, to not get confused, right? Market moves in two ways. It seeks out liquidity, which is the highs and the lows, right? And then it rebalances inefficiency, which is pretty much is fair value gaps or unfilled orders, right? Because why? We have lots of displacement through this move, right? Let's say if this is a bullish, these are two are the bullish fair value gaps. We have a lot of displacement through these through this move, leaving off this inefficiency. So once price ends up breaking the high, it ends up rebalancing to this fair value gap to fill those orders and to fuel the move higher, right? So then boom, we break the high, right? We ran the liquidity, we seek the liquidity. Boom, we went higher. We're not gonna forever keep on going higher because we need to do what? We need to rebalance the inefficiency. So what happens then? We end up rebalancing this inefficiency, and then pretty much what it does, it again fuels the move again, and then price ends up going higher again, seeking out the next liquidity. So this is as simple as it gets. It either seeks out liquidity or rebalances inefficiency. That's about it. So same thing in the bearish scenario, right? We make a move lower, right, with a lot of displacement, leaving off some sort of inefficiency or a fair value gap. Then price does what? Price ends up retracing back to this fair value gap, tapping in here, filling those orders into the what? To fuel the move again, to seek the next liquidity, and then boom, we go lower, taking out this liquidity. We've made this imbalance, right? Then price again acts as a magnet, comes back up, fills this unfilled orders that were unfilled, and then it fuels the move again to do what? To go lower. Now this fair value gap thing concept is very important because that's essentially the main component of my strategy, which I'll be going over like towards the end of the bootcamp, right? It's pretty much fair value gap and liquidity. That's the main two sources that drive most of the strategies, right? You usually look at either at liquidity or inefficiencies, and that is kind of like the two foundational kind of building blocks for most of the strategies, especially in ICT. So pay attention to that. Now let's take a quick look at some of the actual chart examples, right? What do we have here? We have this big imbalance, right? This is a daily time frame, right? So as you can see, how can we tell that this is a fair value gap, right? We have a 3 candlestick pattern formation, right? 1, 2, 3, right? And in the middle we have these this big gap, right, that hasn't got filled. As you can see, I'm gonna zoom in closer, right? You can see that the wicks of the first candle and the third candle do not meet. They don't intersect at all in the middle. So price pretty much is inefficient right here, right? So what it does, it ends up retracing back to the zone and then doing what? Making a move lower, right? Then what happens? Make another fair value gap, right? What is this now? This again, same exact thing as a fair value gap, right? 1, 2, 3, 3 candlestick pattern formation. This gap is over here. The wicks do not intercede. Price does what? After making this big momentum move, right? A lot of imbalanced orders on this area. So price ends up coming back up, filling those orders in, and then going back on lower. This acts as a magnet, acts as a fuel to fuel the move again, because price doesn't just infinitely go down or go up. Now, let me show you what's not a fair value gap, right? This right here is not a fair value gap, right? Because as you can see, yes, it's a 3 candlestick pattern formation, right? But the wicks, as you can see, the wicks intercede with each other, right? There's no empty gap, right? Because the wicks intercede, they touched each other, right? Pause. But there's no gap in the middle candle, right? As you can see right here, if I draw out the lines, maybe that can make it easier to visualize. You see how there's a gap? The wicks don't intercede at all. In this example, you can see like just the one wick alone, like it touches, right, and then it intercedes with each other, so there's no gap at all. So this does not count as a fair value gap, right? Okay, so now let's take a quick look at a bullish example, right? What do we have here? We have a 3 candlestick pattern formation, right? And this big wick, this big gap, right? There's no wicks that intercede with this fair value gap, right? As you could see, this whole entire gap is unfilled. There's a lot of inefficiencies in this market because literally you could see this one big candle that had a lot of momentum, right? A lot of orders were unfilled. So price does what? After making this inefficiency, after making this fair value gap, price ends up coming back, filling those orders in and then continuing to move higher, right? So this constantly keeps on happening. Fair value gaps is one of the most powerful tools that you could use for any strategies out there, really. Okay, let's look at another example of what fair value gap does not look like, right? So in this example, is this a fair value gap right here? No, it's not, because you see this whole area, see how the wicks touch each other, they intercede, right? So they intersect with each other, so there's no gap in the middle, right? The middle candle doesn't have any sort of a gap, so there's no fair value gap in here, so it does not count as a fair value gap, right? Now, fair value gaps could look different. They don't always look and three same with the colors, right? The two colors could be the same, one color could be the same, right? So let me show you guys a few examples. Okay, so as I said earlier, the colors don't always have to be the same, right? So in this bullish fair value gap scenario, right, we don't exactly have all three green candles, right? We don't have, in my case it's blue, but in your case it would be green, right? So these are bullish examples, bullish fair value gap, so it doesn't have to be the same color, right? We see one blue candle, second blue candle, the next one is white, but it still acts as a fair value gap, because why? It's a three candlestick pattern formation, right? We leave this gap, the wicks haven't touched, they haven't intersected with each other, right? But it still acts as a valid fair value gap, right? It comes in, it respects it, right? And then it goes higher, right? So as you can see, the next fair value gap right here, right, still is not same colors, right? It's not the same colors, and we have multiple fair value gaps in this leg, right? So we have these two fair value gaps now, right? We have 1, 2, 3. We have this fair value gap right here, and then we have another one, 1, 2, 3, right? Let me just delete this one. But this is green, green, and red, right? But then price ends up coming and tapping this fair value gap, and it still ends up respecting it, right? So the colors don't always have to be the same, but it usually is more beneficial if they are, because if they're all the same color, then it's a lot more stronger than if it was two of the same colors compared to three, you know. So don't pay attention too much to that, because it's still, as you can see, even though if it's not the same colors, it still acts as a valuable and a working fair value gap. So it's just another thing that you gotta know. Again, just show you more examples, right? Now combining previous things that we learned with liquidity, right? So what do we have over here? We have this important high, which is this important liquidity, right? Price ends up coming and taking out this liquidity, doing a liquidity run, right? And then it leaves off this big inefficiency, right? Because price, a lot of orders weren't filled here because price was super fast, right? It went up very aggressively. Buyers were in control in this area, right? Leaving off this fair value gap, because we have a three candlestick pattern formation, right? Even though the third candle is red, but it still is valuable. This is still right. This is not, it still acts as a fair value gap. So what happens then? Price ends up coming in, tapping this fair value gap. It pretty much fills some of the orders in that weren't unfilled, and then price ends up going higher, right? So this is counted as a valid fair value gap and is respected. Now another thing that you guys have to know is when a fair value gap gets respected and disrespected, right? So when a fair value gap gets respected, it pretty much means, like for example in this scenario, right, the candles end up coming into the zone, to this rectangle fair value gap that I drew, right? And the bodies end up closing inside of that fair value gap, or the wicks end up going inside, but the bodies don't end up closing below the fair value gap, right? Because if it would, then it would count it as the fair value gap got disrespected, right? So in this case, fair value gap was the fair value gap was respected, because price ended up making this momentum move, leaving off this fair value gap. Price ended up coming lower, right? As you can see, none of the bodies ended up closing below this gap. Means what? It respected, because once it tapped, price went up high, right? So now how does a price look like when a fair value gap gets disrespected, right? Here we have a bearish fair value gap, right? Because we have this three candlestick pattern formation, and as you can see, it got disrespected because this candle ended up closing above this gap that I drew, right? So once the candle and the body ends up closing above or below a certain fair value gap, then it's automatically disrespected, and you could just ignore it, delete it off your charts, because now that fair value gap is not valid anymore because it got disrespected. And that is another thing that you have to pay attention to, because that is part of my strategy that I use, which is called inverse fair value gaps. It's just kind of in the name. When a fair value gap gets inversed, right, instead of respecting it, it just disrespects it, right? We have these three fair value gaps, right? Three bearish fair value gaps, right? We have right here 1, 2, 3, right? A three candlestick pattern formation. This candle ends up closing above this fair value gap and this fair value gap, right? So both of these fair value gap got disrespected, right? So now we can just erase it, right? Now we have this next fair value gap, right? What happens? You see right here how the candle went above it and we left this big wick above it. So this was at some point respecting this fair value gap. So you had to wait until the candle ends up closing, right? So in this case, the candle ends up closing above the fair value gap. Then what does it mean? It means that the fair value gap got disrespected, right? Then moving forward, right, we have this next bullish fair value gap, right? What happens here? Fair value gap gets what? It gets respected, right? Because we make this big 3 candlestick pattern formation, leaving this imbalance over here, right? Price ends up coming lower. See how it leaves off a lot of wicks? This is a very good indication when you see price leaving off like longer wicks at the fair value gaps. That usually tends to show that the price is respecting the fair value gap. So in this case, we see this big gap that got respected because we left off these wicks. Nothing ends up closing below it. The bodies didn't close below this fair value gap, and then price ends up going higher, right? So even this example right here is perfect, right? So we have this huge fair value gap, right? We have these two actually fair value gaps, right? Let's start with this one above it. So this above it, right? We have this 3 candlestick pattern formation, right? Price ends up coming lower, respecting it because we left this big massive fair wick, and price ends up going higher, right? But then we also have a fair value gap below it, right? We have this fair value gap below it, again, same thing, 3 candlestick pattern formation, this gap that was left. Now what happens here, right? You see how this huge wick right here, right? At some point, people were probably thinking that this fair value gap is going to get inverse because this candle at some point had its body all the way down here, right? The body was literally right below the fair value gap, so people were probably thinking that it's going to get inversed. If the body ends up closing below the fair value gap, then it's inverse, and price most likely is to run lower, right? But that's again is why it's so important to wait until the body's closed, because as you could see, the price never got the fair value gap never got inversed, right? Because we left off this massive wick, right? Although price went all the way below over here, right, just way past the fair value gap, right? But it still counts as a respected fair value gap because nothing ended up closing below it. And this is a very good indication when you see like these kind of wicks, then it shows a lot of strength, because at some point the sellers pushed the price all the way lower, and then the buyers ended up reacting to this fair value gap, this inefficiency, pushing the price all the way back up higher, closing again above it. What we learned in the previous videos about candlesticks, right? So as you guys can see, we're starting to slowly put these things together. So it's very important for you guys to follow it in order. So if you're not understanding what I'm talking about, go watch the previous video. This is going to help a lot. But this fair value gap ends up getting respected, pushing up higher, creating more fair value gaps, right? Because why? We have this liquidity zone right here, right? And this liquidity over here, right? These two highs. Once price breaks that liquidity, right? Once it runs the liquidity, it ends up creating an inefficiency, right? Like I said earlier in this video, price does two things, right? It runs liquidity, seeks out liquidity, and after it seeks out liquidity, it does what? It rebalances inefficiency. So this is literally happens every single day in the market, right? So after it seeks this liquidity, after it ran this liquidity, we ended up creating this imbalance in price. Then price did what? It ended up coming lower, filling this orders. Then what? Going a lot higher and higher, right? So this constantly keeps on happening, guys. So once the price ends up leaving this inefficiency, this fair value gap, right, it doesn't have to fill all the way, okay? In some cases, price ends up coming lower. For example, in this case, right, it filled this whole entire fair value gap, right? It got respected and it went up, right? But then in this case, price just ended up going a little lower, right? Just a little tiny lower, right? Filled this inefficiency and then went up higher, right? So the price doesn't have to fully cover the whole entire gap, right? It could even just tap it and it'll still count as being respected, right? And for example here, right, we have this massive fair value gap, right? Huge. Price barely tapped into it, right? Just a very tiny bit, right? But it still counts as a fair value getting respected, right? Because as you can see, nothing closed below this gap. We started to see now bullish candles forming, and price ends up going higher, right? So it doesn't have to close, it doesn't have to fill the fair value gap all the way, okay? As you guys could see, we have a lots of fair value gaps in here, right? We have 3 fair value gaps right here, which is a lot, right? But as you guys could see, this one candle over here ends up closing below all 3 of them, right? So it indicates a lot of bearish momentum, a lot of bearish sentiment, because these fair value gaps were supposed to be getting respected if we are truly in a bullish market, right? So now if you guys can start to understand it slowly, right, these fair value gaps act as a sort of a bias and sort of as a magnet for price to kind of get retracted to, right? It pulls back to these fair value gaps, and you have to just kind of see how does the fair value gap react to price. Okay, so if price ends up closing below it, then we might go lower. Like in this scenario, right, we have price closing below these three fair value gaps, right, just one candle alone closed below three of them, and then price just ended up dumping, right here. Price ended up respecting it, right? Price ends up respecting the fair value gap and is going high, right? So a lot of times these fair value gaps kind of show you where price is most likely heading. Now, I've been showing you fair value gaps on a daily time frame, right? And as you guys know, time is fractal, right? So whatever happens on a daily also happens on an hourly, it happens on the 15-minute, on the 1 minute and second charts, right? So as you go lower and lower, right, you guys are gonna still be seeing all these fair value gaps and everything like that, right? But you guys have to know that the higher the time frame, right, the more powerful the fair value gaps are, right? So if you're, let's say, comparing a fair value gap on a daily time frame compared to a 30-minute, and if a fair value gap taps into like a 30-minute fair value gap, but it also taps into a daily, right? The daily is more powerful. You have to pay attention to the one that's higher time frame, right? Not the one that's lower. So for example, right, this is a 30-minute time frame, right? We have a lot of fair value gaps, right? For example, right here we have this bearish fair value gap, right? Price ends up creating this three candlestick pattern formation, right? Ends up tapping it and going lower, right? So this constantly keeps on happening on every single time frame, right? Let's go on a lower time frame. Let's go on a 5-minute. Fair value gap gets disrespected, right? We have this bearish fair value gap, right? Price ends up closing above this fair value gap, right? Price goes up high, right? Then we create bullish fair value gaps, right? Price ends up closing below both of the fair value gaps, and then what happens? It just dumps. You know what I'm saying? So it's very important for you guys to wait until the candles close. You have to wait. Keep on trying to emphasize this, but it's very important to wait until the candle body ends up closing either below or above the fair value gap, because that will tell you the true story of what's happening and if the fair value gap is getting respected or disrespected. Also, another thing that you guys have to know is the fair value gap can get tapped into more than one time, and it still would count as getting respected. But the more times it gets tapped into, the more weak it gets, right? So for example, we have this bearish fair value gap right here, right? Three candlestick pattern formation, right? 1, 2, 3, right? Price tapping into the zone, right? Going lower, coming up again, right? All the way back up here. Some of people might have thought that, okay, we might close above it, that's it, just start buying, right? But no, the wick, see how much of a wick we had over here? Sellers ended up pushing the price all the way lower. This fair value gap still is getting respected, right? Because nothing closed above it. So this bearish fair value gap still got respected. Price went lower. We tapped in here. Price went a little lower. And then eventually what happens? Eventually price ends up closing above this bearish fair value gap, right? Even though we still went lower, but at some point we just went higher, right? So a lot of the times the fair value gap could get tapped into more than once, right? Which is still valid, doesn't make it less valid, but the more times the fair value gap gets tapped into, the more likely it is to break it, because at some point it's going to break, it's going to get disrespected, and price is likely to reverse, right? And then you have to pay attention. Then if you have multiple fair value gaps in the leg, right, then you would be looking something as like, it's called the premium and discount levels, which is again something for the next video. But pretty much if you have multiple fair value gap in the leg, the one kind of higher is again more powerful, right? We have 3 fair value gaps in this leg. I don't want you guys to confuse you with all these lines and boxes and stuff, but you guys got to see this. So see how this this first fair value gap got broken, right? But what happens then? Why did price end up going lower? Because we tapped into a higher fair value gap, which is over here, right? So price ended up tapping on the fair value gap again, getting respected because we went all the way back down here, right? Then price did what again? Came up for this fair value gap, went lower again. So it's getting respected multiple times. 1, 2. So like tapped once, tapped twice, tapped 3 times, respected, tapped the 4th time, respected, tapped the 5th time, it got respected, right? So this fair value gap is still respected, it's still valid, right? But then it happens at some point, the fair value gets broken, right? As you can see right here, the candle ended up closing above this fair value gap, so it is no longer valid. This fair value gap got inverse, right? Then we have this another fair value gap, which is our last and final fair value gap in this leg, right? But it also got inverse, and price ended up, going higher. So this constantly keeps on happening, guys. Like I said earlier, right, the fair value gaps happen on every single time frame. I'm on a 4 hourly right now, and then fair value gaps happen on an hourly, 30-minute, 15-minute, 5, all the time frames you can think of, they all happen on every single time frame, right? But it is also very important to note that the higher the time frame, the more power the fair value gap holds, right? So if, let's say if you're looking at a 4-hour fair value gap, right, but then there's also a 5-minute fair value gap inside that 4-hour, and then the 5-minute ends up closing above it. Now you're not gonna go and pay attention to the 5-minute because we're on a 4-hour, because again, why? The higher time frame matters more than the 5-minute, right? So let me just show you an example. This is a 5-minute time frame, right? There's the highest fair value gap in this leg is this 5-minute, and it's the highest in this leg. As you guys can see, there's no fair value gaps above it, right? So we're looking at the 5-minute fair value gap, right? Now you have to wait and see until the 5-minute candle ends up closing above this fair value gap or respects it, right? In order for it to be either respected or disrespected, right? You don't go on a lower time frame. You don't go on a 1 minute, 2, 3, or 4 minute. And if that candle gets up closing above it, then you don't just automatically enter, right? So for example, right here, you go lower on a 1 minute, right? So let's see what the 1 minute does. Boom. 1 minute candle ends up closing above it, right? Now, let's just say you entered a long, right? Because the 1 minute ends up closing, right? We go back on a 5 minute, what happens? Price ended up dumping, right? Because why? You did not wait until the highest fair value gap in the leg gets closed or not, right? So we're looking at a 5 minute, right? You have to wait and see until the 5 minute ends up getting closed. Doesn't matter if the 1 minute ends up closing because it's not the highest fair value gap in the leg. So you have to wait until the 5 minute gets closed, right? Let's just take a quick look at another example, right? We have a 30-minute fair value gap right here, right? As you guys can see, it's a 3 candlestick pattern formation, different colors, right? We have a white, blue, still is valid, right? It's still a bullish fair value gap, right? So this is a 30-minute, right? You have to wait and see how the 30-minute ends up closing, right? In order to see if it gets disrespected or respected, right? So in this case, this 30-minute. So boom, we have not only one, we have 2 candle closures below, right? These 2 1-minute candle ends up closing below this 30-minute. So some people might have ended up shorting because they thought that's it, the candle got the fair value gap got disrespected, so now we're gonna go lower. But in fact, you see how we started chopping as well. A lot of candle closures below it, right? Let's say, like, for example, a 2-minute, 2-minute ends up closing, 3-minute ends up closing, right? So, but again, you have to pay attention to the higher time frame fair value gap because they always hold more power than the lower ones. If you go back on a 30-minute, what happens? The candle does not close. In fact, we do what? We push higher. And right here we see how this bearish fair value gap, right? This bearish fair value gap gets disrespected, right? So after this bullish fair value gap gets respected, this bearish fair value gap gets disrespected because the candle ends up closing above it. And then what happens? Price just goes higher, okay? So this is it for this video, guys. It's very important for you guys to understand these fair value gaps, inefficiencies, imbalances, low volume nodes, whatever you guys want to call them, however you guys were introduced to them first. But in ICT concepts, this is pretty much known as fair value gap, right? But it's pretty much the same thing, okay? So if you guys don't understand anything, drop a comment, I'll help you guys out. But there's going to be multiple parts to this because fair value gaps, you kind of got to go a little more in depth into it. Same with liquidity. So wait for part 2 for both liquidity and fair value gap later in the bootcamp. But as for now, this is it. So I'll see you guys later.